The market is a very, very beautiful mechanism where the money goes from the hands of those that are impatient, that are trying to make fast money, whatever, to the hands of those that are patient, that are, that can control their emotions and that know the power of patience. And this is all going to greatly benefit you if you are one of those traders. When the market goes down to those levels, I have a strategy that you can implement into your trading that I think can greatly help you. So, what you can do is, let's say you're looking at a stock like Google, right? Let's go over Google. Do you see how Google is getting very close to that rising support trend line? Let's say Google retests that trend line and has a nice, let's just say that it has a nice reversal. Or, yeah, let's just say that, okay? Or let's just say that a trader decides to add right now, this week, the trader decides to buy Google when it goes back up to 163, and the trader ends up picking up the March 21st. Let's just say this is just an example, okay? The March 21st, and let's say the trader is going to pick up the 200 call. The 200 call today is down about 20 to 25%. That's really, really good. And this is where we are sitting at. So let's say that or I will give a better example. Okay, although I do love the March 21st, but let's just take a look at something better, because what I do is, if I'm going to do something like that where I average down another contract, which is the strategy that I'm trying to show you, I would give it more time. Okay, so the June 20 2025 call expires in 319 days, and this contract is getting very close to the 5.0 to the 6.0 range where we can buy this long term. So let's say that this stock, Google, goes down another day towards the $152 range, and this contract here for June 20, 2025, the 200 call strike goes down to around 5.0 to 5.30. Okay, let's just say that. If that turns out to be the case, you can buy a contract there. You can buy one contract there, and what you do is, as soon as it goes down, as soon as, let's say you're wrong and this is not the full on bottom, it goes down a little bit more, right? And even if it's a big drop, let's just say another $10 drop, that's perfectly fine. Your options, they're going to lose value. And what you do is you average down another contract there, and now you have averaged out your contract to a great level where, with the smallest rebound, you're going to get very close to where your break even was. And then what you can do is, as soon as the contract goes up a great amount, you can de-risk one contract at, let's say, 25 to 40% profit, and you can keep the second runner as much as possible so you can catch that 200, 300, 400, 500%. Now, I use this strategy. I want to talk about how this strategy would have worked out so well on Apple. And I'm so sorry if I'm boasting here, because, team, I'm not boasting. I'm really just trying to show you how we do this. Okay, I'm trying to show you my strategy, because I'm telling you, this is going to work out so amazingly, so beautifully well if you execute this the way that we are trying to. So I'm gonna go ahead and type Apple 01 just to find that contract. Please give me one moment, okay, team? Give me one moment. Check this out, team. So we're gonna go and look at this Apple contract, this Apple analysis. Okay, now this Apple analysis, do you see where it was? Just to show you really fast, let me zoom in. You see where Apple was trading at the time? It was trading at $170, okay? It was trading at $170, and we were buying close to that support level. Why did we buy at that close to that support level? Because we know Apple's a very, very, very strong company long term. We know that there were several signals. We talked about the RSI failing 3 times, which, the TTM squeeze failing the transition 3 times, which means the 4th transition is usually the greatest short squeeze of all time. And let's take a look at what I said about this analysis. Apple stock refused to break down, blah, 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 blah. Here are holding here means that we have room to 182, 195 in the upcoming months. Eyes on the Apple leaps. They're so cheap. If they fake out, I will average cost another contract in 3 to 5 weeks. And I'm going to explain this fake out in a second in how that affects you in that time being, and how that can greatly benefit you in the future. So you can see, what did I say here? I said if we see a fake out, I'm going to average cost another contract. The setup looks great to me. And then same thing here. Same thing here. Um, if they go down or sideways for another 2 to 3 weeks, I will average down another contract and wait patiently on this sleeping giant. You cannot make this up, team. I called it a sleeping giant. And then this contract here, which is the June 2025 call, 220 call at 5.20 for the future, could honestly be amazing. The best way to utilize this investment is to hold it for as long as possible. And now let's go back to Apple and see this. You see this big zone here? I'm going to remove this real quick. Let's just create a new chart because, I'm just going to leave it because we have new data here. So it's kind of making it messy. But that consolidation that you're seeing at the 170s is that level right there. It's that level right there. And let's take a look at, so we said right here, we said we were going to average down another contract in 2 weeks. This is 2 weeks later, and you see it came down to 165. Let's say we added another contract from what was the price? From 5.20, let's say around 3.90 or 3.80, we added another contract that brings down our average to about 4.30 area, right? 4.30 area on our average cost. And let's go take a look at the June 25, the 220 call and see where that contract went to. So that contract went to $3,699. So almost $3,700. And you can take a look at it very, very well. This is how it played out, team. I'm telling you, this is how you make money. This is how you make money. It doesn't matter what happens within that short-term time frame. What matters is that you are catching an amazing opportunity for the long term. And that's what we want, okay? That's what we patiently have been waiting for. And seeing NVIDIA down here, seeing Google down here, seeing Amazon down here, that's all I'm seeing. I'm seeing money signs, and I'm just patiently waiting to see if we are going to see more downside so that I can catch it a little bit cheaper. So what I'm trying to show you with this example here, team, is that that's what you do, okay? This is my strategy here, and you cannot do this on short-term expirations, okay? You have to do this on long-term expirations that give you plenty of time. And pretty much you don't want to do it on short-term expirations because, again, what we are essentially averaging down on is not only the strike price but the loss of time, the loss of other factors that also account for time and all that stuff. So the interest, we're averaging down on the interest, all the good stuff. And when we come back up and we pretty much get closer to our strike, all of those values also amplify, which really work out so beautifully in our favor. So hopefully this example gives you a good understanding of how the market behaves and the psychology behind the short term, and the great reward for the long term if you just convince yourself that this, you know what I mean, like the investment in the longer run, the investment is going to work out. Now, another point that I want to mention right here is the way to utilize this investment. You can see I called it an investment. Why do I call this an investment, team? Because if I was, if somebody else was, was certain that or not certain, if someone else had a feeling or a hunch that this was going to see a big rebound towards the 197 resistance level that we talked about in that analysis, perhaps they would have gone with shorter term expiration. Perhaps they would have gone with September or something, giving themselves extra 2 months. But the way that I think, the way that I found this strategy is, I'm an investor at heart. So if I get that move right, what I would want to do is I want to have a better investment, a more durability on that contract, so I can even decide if I should keep this investment longer. And that's why I invest in it with much more time, with much more durability, because that itself, I understand traders will focus on the short term, but my focus is, the longer term, the durability, and the opportunity for more time gives me more of an investment, so I can I can utilize more of this move. And that's something that I also want you guys to learn from this, because time is really key. Like, I'll show you some of our investments that have gone wrong. Lulu has gone wrong, Ulta has gone wrong, and they have lost 50%. Okay, they have lost 50% of their values, and we can sell them here. They have lost 60% of their values. We can sell them here at our stop losses. But then you do another trade, and that trade comes out to be right. It gives you far more than 100%, far more than 50%. So don't be discouraged. Don't be discouraged by this strategy. Try to implement it into your trades, and I think you're going to do an amazing job. So yeah, team, this is basically my thought process on the strategy that I'm trying to illustrate to our team. And the same thing, when the S&P 500 goes down to, oh, and now that we have discussed this, so team, when the market goes down for that short period of time, something else to keep in mind, okay? When the market does, even if the market, let's say, goes down lower to, let's say, around these levels at 478, somehow, some way, let's just say this happens, okay? This happens to bankrupt some funds out there, some hedge funds or whatnot, whatever the reason may be, to punish those that were greedy, that were basically, that threw their rules out of the window to try and, dig themselves out. Those are going to go bankrupt, right? And what happens is, despite us going down really, really hard, just know, when holding those long terms, you're going to see really big moves that instantly correct those contracts, correct the price, and it's like nothing happened at all. It's really like nothing happened at all. So this is another thing to really be confident about when approaching this kind of strategy. You just want to really give yourself time, because time is a very, very crucial factor in options. Time itself can really increase your probabilities astronomically, honest to God, really astronomically, because I've seen traders, and I've seen it over and over and over, and even for myself, I've been wrong by one day, I've been wrong by one week, where my contract has expired, and then I've seen over 500 percenters